hear us and see us well? Mina, please let me know if everything is good.
Yes,
Great,
yes.
great, awesome. Can can I ask everyone to just introduce in the chat box your name and your organization? I think that would really help us understand where everyone is coming from. So just your name and your organization, and hopefully in 30 seconds we start. Thank you. Thank you, Manal. Thank you, Abu Bakr. Thank you, Kaval. Thank you, Dr. Jamshed, Anusha. Welcome, Maria. Great. So we've got a very diverse set of audience today, and I hope that this webinar is going to shed light on a very useful topic and will be useful overall. So again, before we begin, I want to say again a very warm welcome to everyone who is participating with us in today's webinar. This is going to be first of our ESG webinars, and hopefully we'll continue to do so. Resources future. And if you want to know more about us, you can go to our website, resourcesfuture.com. We work in the areas of carbon markets, climate policy, climate finance, as well as ESG. Let's begin. Next slide. All right, so we've got a very concrete sort of an outline. We'll try and compress S1 and S2, which are the emerging new standards, and S1 and S2 are difficult to compress in 60 minutes time, but we'll try and give a very preliminary overview so that everyone can sort of understand what these standards are, what they sort of discuss more broadly, and how organizations and companies can use them to sort of standardize the reporting when it comes to sustainability and climate. Next slide. All right, so before we begin, and I think with me today, I'll be joined by one of my colleague, Roma. Roma will be taking us through the granular details when it comes to S1 and S2, and I'll be doing an introductory part. But before we begin, I think it's important to sort of understand from a case study perspective. This is a hypothetical company. Let's assume this is a company called Green Corp. And Green Corp is a powerhouse in renewable energy manufacturing solutions. Now, try and understand that. Let's suppose we have this company, which is a global leader in renewable energy solutions. And for years, Green Corp is celebrated as a pioneer in sustainability because they come with a mission for energy transition. They come with a mission to introduce more and more renewable energy solutions. And of course, investors are drawn by its very strong ESG credentials and commitments to a greener future. However, and that is where I think a lot of things play out. There is one set of things that we understand which are right up front, but there are the completely different aspects which are working behind the scenes. And for this hypothetical company, let's assume that Green Corp is it has come to their knowledge that they are sourcing materials from areas, from regions with questionable labor practices and high environmental risk. Somehow these risks were not adequately identified by themselves and then disclosed subsequently in their financial reports. And somehow the investors and all the investors, whether they are institutional investors, whether they are individual investors, retail investors, all people tend to think about is that this is a great company with solid ESG credentials. But of course, no one really knows in terms of the climate vulnerabilities or the sustainability vulnerabilities that they possess. And try and think about, when we are discussing Green Corp, try and think about your organizations. I think, we are all committed in terms of our own sustainability credentials. Everyone wants to contribute positively to society. But at the same time, organizations not entirely by design, they're not entirely aware of what is going on behind the scenes. So it is important that we have a framework available whereby we can first identify those risks and opportunities and then highlight them within our financial statements and financial reportings. Next slide. So, you know, continuing with this case study, then comes a crisis. A major supplier of our hypothetical company, Green Corp, is exposed for illegal deforestation practices, which not only leads to legal penalties, but also severely damages Green Corp's reputation. So now everyone is sort of aware that that Green Corp has solid ESG credentials. But now that there is a case, now there is a very um, case which is larger in scope, larger in size, larger in magnitude, and now it is sort of coming in the limelight, whereby people are discussing it, and Green Corp is suffering from a reputational crisis. So investors who have been previously very confident about ESG credentials of Green Corp company now have started to lose interest and the trust and the credibility also. The aftermath of such an event always is that stock price plummets and becomes clear that Green Corp's sustainability practices were not as robust as they seem. So while they're working in renewable energy, while they're working in the energy transition space, they've got all the right matrices in place, but somehow they're not able to highlight, identify, and then report their critical issues, which they should have done had they followed a robust sort of a standard. What lacked? And now, typically every company, and we can put any company in their shoes. So now Green Corp realizes that this approach to sustainability reporting was sort of fragmented, and they needed a more holistic and a more broader sort of framework, which could A, first identify risks and opportunities, and B, help them report those risks and opportunities to wider audiences. And just to regain credibility and show long-term success, they need to overhaul their reporting practices. And this is a very similar case. This is something which is which happens a lot. I think there are several case studies whereby companies have been lauded first, they've been appreciated at first, but then somehow these practices, when they've been highlighted, that they suffer from fragmented reporting. There is this case whereby they could suffer that reputational crisis and need to come back from it. Next. Slide. All right, so the turning point, and I think the turning point is that now this is where the IFRS S1 and S2 standards come into play. So now the company has decided that they want to overhaul, they want to adopt to new standards to rebuild trust and ensure that all sustainability risks and opportunities are fully integrated into the financial reporting. And now they feel that IFRS S1 they will be able to provide a clear and comprehensive picture of the material sustainability risk in its operations, such as supply chain risk or environmental impacts. And with IFRS S2, they would be able to identify and have a process in place whereby they can also disclose how particular climate-related risk and opportunities can be managed and potential impacts can be sort of mitigated. So this is a very typical case study, and the idea for bringing this up front is to really understand that this can happen to any organization. All organizations want to do good work. All organizations want to make sure that they are standing on the sound principles. However, when they go on the field, they realize there is one reputational crisis which they have not really foreseen, which they have not sort of understood well. And had they implemented a framework, they would have been able to capture it and make sure that somehow those risks are mitigated and reported as well to the wider investor community. Next slide. And before we go into S1 and S2 standards, I think it is important to understand also one major thing which is happening. One major thing which is happening across the globe is that we have seen a world of fragmented reporting. And by that, we mean that there have been so many standards. There are so many standards which even exist today. We've got GRI, we've got SASB, TCFD, UNGC, PRI. There are several others. But now what we are seeing, I think, is a transition from there are two things at play. One is that we are seeing a lot of voluntary standards. They are now beginning to shift to compliance standards. So it is more and more important, becoming more and more important that we are now into a regime whereby we don't have the luxury of voluntary reporting. We have to report no matter what. And I think that's something which is coming into play with IFRS S1 and S2 standards. A lot of synergies that we're going to discuss next, but a lot of synergies are coming into play, whereby we are going to see that this convergence will take place and this standardization will happen in due course. The second thing, which is again very important, I think sustainability used to be thought of as a standalone thing, and financials used to be thought of as a very different standalone thing. And now I think what S1 and S2 are doing, they're trying to sort of unify both the sustainability standards as well as the financial standards. So I think one overarching framework that you would see is that in by adopting to IFRS S1 and S2 standards, we'll see that under the management commentary of the financial reporting, we'll also see sustainability reporting. Yes, there will be linkages. Yes, there will be interconnected information. Yes, there will be places where we can cite that more information can be found in this section. But overall, we are not sort of thinking of sustainability as something which is unique and something which is distant from everyday day-to-day operations. We are going to start thinking of sustainability as something which is very core to business operations, and hence S1 and S2 they will be reported side by side, literally side by side with the financial reporting. So I think that is something which is in the works, and everyone will have to comply. IFRS is something that we all comply to, and S1 and S2 are going to be important areas where these things will begin to sort of gel in. Next slide. So very quickly, and before I think we move forward, we have a comprehensive suite of services when it comes to ESG. We understand, we prioritize sustainability-related risks and opportunities. We help companies deliver strategy development when it comes to ESG. Conducting materiality assessment, something that's always been very foundational, very, very important exercise, that which areas are material. Can everyone hear me now?
Yeah.
All right.
Yes.
Sorry about that. Sorry about that. There was some internet disruption. So, and then risk management, corrective action plan development. We help companies with sustainability reporting. And one of the very important ideas that we try and do is to deliver corporate training and capacity building solutions. This is something that we understand. It is something which is in the works, something which is up and coming. And if there is any way where we can contribute to the suite of ESG services that the companies are trying to sort of understand and navigate this spectrum, that is where we come in. We would be happy to engage. If there is anything, please feel free to reach out to us. We'll be leaving our email addresses on the chat boxes. And we hope to continue with this session. And I'll just hand this over to my colleague Roma to take a deeper dive in S1 and S2. Over to you, Roma.
Thank you, Karam, for setting the stage, and also thank you everyone for joining us today. So before we dive into IFRS S1 and S2, it's just important to emphasize on what Karam has already discussed, that why these standards and frameworks are needed in the first place. So the objective of a standard is to streamline the reporting process so that whichever information is disclosed remains consistent and is complete and useful for the investors, and is also comparable. So currently we have more than 80 frameworks and standards related to ESG and sustainability disclosures, which kind of negates the whole concept of simplification and standardization. And to deal with this, the IFRS Foundation took the initiative of developing S1 and S2 standards, which came into force in 2024. These standards serve the purpose of forming a global baseline for sustainability disclosures, which are designed to meet the information needs of particularly investors. Here, investors would also include creditor, lenders, and other participants from the capital markets. The IFRS standard the I think we're having some internet connectivity issue, but I'll continue. The IFRS Foundation established the International Sustainability Standard Board, which is an independent body as well as S1 and S2 have the objective of disclosing sustainability related risks and climate related risks. S1's objective is to disclose information to assess the effect of sustainability accounts financial value are used in conjunction with S1, and it is specific to climate related risks and opportunities. Next slide, please. Okay. Before we dive deeper into S1 and S2, I think it will be important we understand the link between the company's ability to deliver financial value to its investors as well as sustainability. According to IFRS, the sustainability of a company to deliver financial value to its investors is linked to three aspects. First, it is linked to the stakeholders that the company serves. Secondly, the society it operates in. And third, we have the natural resources that the company draws upon. So, in order for a company to function sustainably and avoid and minimize its sustainability related risks and increase the opportunities, it should maintain its resources and relationships and also manage its dependencies and impacts throughout the whole ecosystem of the company over the short, medium, and long term. I'll explain this and simplify this through an example. So, for instance, imagine we have a textile company situated in Pakistan. Let's call it Company A. Now, this company exports apparel and fabric to EU and other markets worldwide. What happens is that EU is adopting low carbon trade policy or is reducing its carbon footprint, and this could affect the company's exports. Now, the company has two options. Company A could either invest heavily in its processes and decarbonizing its and making its processes efficient. This will also mean that it will have some costs to bear. And the second option is that the company could continue to export to other geographies, but it will have more competitors when it wants to export to EU. That would also result in decrease in exports and sales. This results in financial loss as well. So in both cases, there is a financial impact. And this is critical information for investors, which should be disclosed by companies. And for this reason, the IFRS standards provide general requirements for disclosure and reporting. Let's explore the emergence of ISSB and IFRS because this will help everyone understand how different global standards and frameworks were adopted, and the ISSB built upon the works of these standards and frameworks to form S1 and S2. In 2020, the CDB, CDSB, there is a need to develop a standardized, comprehensive reporting for corporates. And this was the first milestone. And in the same year, the RFP developed a guide so that the companies can apply both these standards together. This was also a major step in the consolidation of standards, because GRI is more of an environment and of company and stakeholders. SASB standard focuses on the impact of external environment on the company's performance itself. In 2021, then the Value Reporting Foundation was formed, and this was done through the consolidation of SASB and IIRC, which which further developed the standards for final value creation. In 2022, we finally get the International Sustainability Standard Board through the consolidation of Value Reporting Foundation as well as CDSB, which is the Climate Disclosure Standard Board. And then ISSB worked on and developed on the findings of TCFD, SASB, as well as CDSB to launch S1 and S2. This whole timeline is to just show everyone that how S1 and S2 have consolidated a lot of globally recognized standards into one requirement, and this is the way forward. Okay, so now we finally move on to the contents of S1, but this is just going to be an overview and brief description of S1. S1 provides general requirements for disclosure of sustainability related financial information. So S1 requires entities to disclose information about their sustainability related risks and opportunities that is useful to investors in making decisions. Now, what this information is, it could be any information that could be expected to impact an entity's cash flows or access to finance or cost of capital over the short, medium, and long term is expected to be disclosed under these standards. But not all information is valuable and needs to be disclosed. Only material information is required by S1. What is material information? The IFRS S1 states that information is material if omitting it or misstating it or obscuring could influence an investor's decision. If we generally, a lot of standards have materiality assessments to assess whether a risk or opportunity is important for disclosure or not. So in case of IFRS S1 and S2, this is determined if a risk or an opportunity has a high impact on the company's business itself and is also of high priority to the stakeholders, which are the investors. Those risks would be termed material, and generally they would lie in this red shaded area. So these risks and opportunities need to be disclosed by the company. However, additionally, if a regulation requires entities to disclose a particular information that may not be of value to investors, that information is also considered material and must be disclosed according to S1. Okay, so I hope by now materiality and the objective of S1 is clear to everyone. Here we have the core contents of S1 where disclosures are required. Whoever people who are familiar with TCFD might already recognize these because these are the four key pillars from TCFD. Number one is governance. So S1 requires companies to disclose their board's oversight on sustainability related issues, and also the management's roles and responsibilities on how they manage these issues. Now, this is an important step because this ensures that sustainability related disclosures are treated as business as usual in a company rather than a one-off exercise or like a separate exercise. Second, we have strategy. In this, the standards require disclosure about material information. So, any material sustainability related risks and opportunities would be disclosed here. Then it also requires companies to disclose the impact that that information might have on the company's financial performance, and finally how well prepared the companies is to deal with those risks and opportunities. Third, we have risk management. Here, the S1 standard requires companies to disclose information on how it calculated or achieved that material sustainability related risk and again, apologies. I think we are having some internet issues here. But let's continue. We were on metrics and targets. So S1 asks companies to disclose the metrics that it has used to measure and quantify these risks and opportunities, and then also the performance it achieves for any internal targets it has set or any targets required by the regulation. I'll give an example here for better understanding. So let's go back to our example of company A, the textile company. So that company, textile companies usually generate a lot of waste, and let's assume that according to S1, waste generation and disposal is a material risk for company A. Now, how the company will quantify waste generation is that it could annually measure in tons the amount of waste it has generated, and then it could also have internal targets. For example, the company could decide that it wants to reduce its waste by 50% in the next 5 years. So in every year, the company will report its performance against that target, and also link that to the financial performance of the company. So these are the key areas where S1 requires companies to disclose their risks and opportunities. Now moving on to S2. S2 is similar to S1. It just asks for climate related risks and opportunities rather than general sustainability related risks and opportunities. And the climate related risks are generally categorized into two broad categories. First is physical risks, and second is transitional risks. Physical risks relate to the physical impact of climate change. So, for example, if company A is situated in an area which is prone to flooding due to changing weather pattern because of climate change, and it anticipates that in the coming years, its industry could be damaged and its processes could be halted, that would mean that there's a cost or financial loss associated with this risk, and the company should prepare for it. So, this is a physical risk. Transitional risk relates to transition of a company to a low carbon economy. So if we go back to the company A, it was exporting to EU, and it required to decarbonize its operations in order to maintain the exports. Now, this is a transitional risk, and in order to do that, of course, the company will have to invest in renewable energy and other processes. and there is again a financial implication to this. So these are the two broad categories of climate related risks under which disclosures are required. Next, we have the key features of S2. Now, S2 asks companies to disclose information in these three areas. First is transition planning. So, what are the plans that a company has in place to move towards a low carbon economy or decarbonize? That needs to be disclosed under S2. Secondly, S2 asks companies about the resilience of their strategy and the business model uh, to climate related issues under various scenarios. For instance, if a company anticipates a scenario, its risks and opportunities under a scenario of 2 degrees Celsius rise in global average temperature, how well the company is prepared to deal with those risks. And third, we have GAG mitigation. So this is the most important feature of S2. It asks companies to disclose information on its GAG scope 1, 2, and 3 emissions. And here it recommends the use of GAG protocol. Okay, so now we come to the interesting and interactive part. I would like every request everyone to use the chat box for this, and let's see different cases. So we have a case of a textile industry. We could still say it's that company A, and it is operating in Pakistan. It's exporting worldwide. What could be, in your opinion, the sustainability related risks as well as opportunities that it will face or is expected to face, and how do you think that would impact the financial performance of the company and of course impact the investor's decision? So please use the chat box, and just whichever risks come to your mind and opportunities come to your mind, you can list them. Okay, so Manal says water and chemical pollution risk. Yes, that's right. And how do you think, Manal, it could impact a company's financial performance or result in financial implications? Physical risk, raw material, yes, right, Zishan. Wastewater generation, yes, GHG emissions. We have identified the risks. Maybe there are some opportunities as well, and maybe we could try to link them to the financial effect or impact it would have on the company. Right, noise exposure. Okay, great. So, thank you, everyone. So, all most of these risks are actually going to result in some sort of a cost, like Manal is already mentioning. Fines could be imposed on the company, correct, for not following the regulations, and they could be penalized, correct. Great. Okay, let's move on to the next slide. Okay, now we have another example. This is from a food industry. It could be any food processing industry. And just think through the whole supply chain. So, from raw materials to the end product, what could be the material disclosures that this company should do? Yes, resource wastage, climate change impacts. Yeah, they should disclose the type of packaging materials used. Correct. Also, if we look at this from an opportunity perspective, for example, currently a lot of companies use plastic packaging, right? And that is not environment friendly, but there is a cost associated with moving towards environmental friendly packaging, or maybe just cardboard. But it would also be an opportunity because that would attract a separate market for this industry, people who are consumers who are more environment aware and want to opt for sustainable lifestyle. So that's one pro. Okay, great. I think we can move on. All right, we have a real case from Africa's mining sector, which is interesting because it relates the risk mitigation to how companies can tap sustainability related opportunities. So, what happened in Africa is that the mining sector exports is a major exporter of minerals to US, Europe, and other economies. But the processes were very limited because most of the mines were not to electoral, and that boosted their businesses, and they could make more exports to these countries. This also served as an opportunity because now we see a lot of these economies, especially the EU, is moving towards low carbon trade and other low carbon policies to reduce their carbon footprint. And the mining sector of Africa is already well prepared for it, and it is a competitor for other mining in sector countries. And what there was additional social impact as well. So the surplus energy and electricity supplied to the neighboring communities, and that results in job creation and upliftment of the community. So we see that this whole process of assessing information and identifying risks is not isolated from identifying opportunities and then tapping these. Okay, now we can go through the qualitative characteristics of useful information. We saw that S1 required companies to disclose useful information to investors. What is this useful information? So IFRS states that information is if the information is relevant and faithfully reported and fairly presented, that is considered useful. Fairly presented information will fulfill four criteria. So, comparability, verifiability, it should be provided timely, and it should be understandable. Comparable information means that, for instance, one mining industry or company A, the textile industry, has disclosed its sustainability related information. It should be the investors or readers of the report should be able to compare that information to disclosures of a similar other textile company, so that they have an idea of how these industries are performing. Second, we have verifiable, so all the data and metrics and performance should be feasible and verifiable. Back to the source, and information should with along with the final annually. So this could be annually. And lastly, if the information is understandable, it will be easy for investors to link sustainability to financial value of a company, which is the whole purpose and concept of S1 and S2. Khurram has already detailed the applicability of S1 and S2, but just to go through this again, the IFRS has its accountability standards, which are adopted by 140 jurisdictions, and it is expected that eventually all of these jurisdictions are going to adopt sustainability disclosures as well, the IFRS's disclosures. Currently, the standards require large and listed companies and public interest entities to report, but soon they will be updated to cater for SMEs as well as other small and medium companies. And if companies wish to report on their sustainability disclosures voluntarily, they can start using the IFRS standards as well. Okay, when we discussed the timeline through which the standards were prepared, S1 and S2, we saw that the standards built upon the work of multiple other existing standards and frameworks. So the S1 recommends companies to use SASB standard if they want to report on industry specific disclosures, as this is a comprehensive guidebook. And if a company wishes to disclose water and biodiversity related information, it could always refer to CDSP framework. And lastly, whenever reporting is done through S1 and S2, an integrated approach is used or should be used as the integrated reporting framework recommends. Next slide, please. Okay, here we come to the end of our presentation. So let's summarize what we have learned today. First of all, we know that the ESG and sustainability disclosure landscape is evolving, and soon there's going to be standardization globally, which is why the S1 and S2 and the upcoming IFRS standards are likely to be adopted worldwide in conjunction with accounting standards. And the sustainability related risks and opportunities, of course, cannot be solved in isolation, as we saw with the example of Africa's mining sector. And another point is to always have and use an integrated approach when disclosing sustainability related information, so that the information could be linked to financial performance of a company. And lastly, preparers who are interested in adopting S1 and S2 or are already beginning to adopt it may begin with evaluating their internal processes and systems to enhance data collection and ensure that you understand risks and opportunities, and also start reviewing the parent standards, which are SASB, TCFT, and CDSP, as they are well established and already have been used extensively. Next slide, please. Thank you, everyone, for staying with us. And with this, we conclude our presentation. And now the floor is open for question and answers. Please use the chat box for your questions, and we'll get to them. Hassan, great question. So IFRS standard is basically focuses on financial materiality. So it requires companies to find that connection between the sustainability information and financial performance of the company. Whereas GRI basically assesses the impact of the company on its stakeholders. So it focuses on double materiality. We'll have more sessions in the future. So this is like an introductory first webinar, and we'll get into these other standards into detail as well. But if you have any further questions or you want a detailed answer on this, then you can just reach out to us. Thank you. Khurram, would you like to add something to this?
No, thank you, Roma. Thank you, everyone, for staying around, and we hope to listen from more of you. If there are any questions, any way where we can come in and help your organizations, please feel free to reach out. And as Roma mentioned, this is just one of the very few early beginning sessions that we are going to do. Hopefully, the series will continue, and we'll come back to the audiences with more insights on the other standards. Thank you so much.
We still have a couple of minutes, so I'll wait for any other questions, or if in general anyone wants to ask about our services, we are here. Okay, so the server, I hope I'm pronouncing your name correctly, is asking how S1 and S2 guide companies in identifying climate related identifying and disclosing climate related risks and opportunities. So these standards are designed and they provide requirements as well as a framework for companies to adopt in this disclosure. So climate related information would, as I mentioned, would fall under two areas: physical risks or transitional risks, and then the key areas to report on is transitional planning, climate resilience, and GHG emissions. And the standard recommends the use of GHG protocol for calculating and measuring your greenhouse gas emissions. And it follows a similar pattern to S1. So you'll have governance, strategy, risk management, and metrics and targets. And you'll report in a similar manner along with the general requirements which are provided by S1. But we'll also have a separate session on S2. Yes, we can. My email should be visible on the screen, and then I would request Minha to also leave her email in the chat box, and you can reach out to us. Okay, I think there are not many other questions. That either means I explained very well, or people didn't grasp anything, but I hope it's the former. So, thank you everyone for your time today, and I hope this was an insightful session for everyone. And we look forward to your presence in our upcoming webinars on IFRS, but also other standards. With this, I would like to conclude. Yes. So, thank you everyone.
Thank you. Bye bye.
Bye bye.